Trading was paused at 12:15 Central Time on Wednesday. Silver sat at 91.30. Markets came back online an hour and 35 minutes later. The instant trading resumed, price plunged to 88, straight down. No rebound, no pause, just relentless sell pressure the second the doors reopened. Now silver is back at 89.20, defending what previously acted as resistance in earlier breakdowns. That ceiling has flipped into support. Read the code. Now let's break down what really unfolded and why the timing carries more weight than the official excuse. CME Group suspended all metals and natural gas futures trading Wednesday afternoon. The official explanation: technical difficulties. Natural gas resumed at 12:50. Metals didn't reopen until 1:45. That's roughly 90 minutes of frozen markets. No trades, no bids, no offers. Price locked at 91 while the world kept turning. Here's where it gets compelling. This marks the second significant CME disruption this month. In early February, settlement prices were delayed. Now a full trading halt. 5 years without outages, then 2 within 3 weeks. Both instances occurred as silver was advancing toward critical resistance. When trading restarted, silver dropped $3 to 88. Gold fell $70 to 51.64. Not a gradual fade, an immediate wave of selling that felt synchronized, not organic. CME canceled all-day orders and good-till-date orders. Only good-till canceled orders already confirmed remained active. That effectively reset the order book, benefiting institutional players who could respond instantly, while retail traders scrambled to understand what happened. Silver was approaching 92 before the halt. We identified that level in prior videos as the next upside target. Price had cleared 89, flipped it into support, and was building strength toward 92. Then the halt struck as price tested that breakout zone. Interesting how technical issues rarely appear during sharp declines. Shanghai paints a very different picture than Western exchanges. Shanghai spot trades at 101. SHF futures at 106. Western spot sits near 89. That's a $12 premium on spot, and $17 comparing Shanghai futures to Western spot. Physical demand in Asia versus paper pricing in the West. When that spread holds and even widens during Western disruptions, it signals more than simple arbitrage. It hints at structural imbalance. Now to the numbers that matter. COMEX registered silver dropped 2.2 million ounces Tuesday alone. Total registered inventory now stands at 86.3 million ounces. Breakdown: 155,000 withdrawn from Asahi, 167,000 adjusted out of Brinks registered, 647,000 removed from HSBC, 374,000 pulled from JP Morgan, 80,000 from StoneX. Some metal moved into Loomis registered, yet the net result was 890,000 ounces exiting registered in a single session. Each day the total shrinks. Yesterday's 71 million ounce roll was the largest we've seen, easing immediate March pressure. But what's missing is new supply entering COMEX vaults to replace what's leaving. Eligible inventory remains, but it's not committed for delivery. That distinction matters because the structural deficit extends beyond March. Another overlooked detail: the February gold contract still shows 4,000 contracts open, about 12 tons worth $2 billion at current prices. Contracts initiated at the start of February should have been delivered or rolled by now. They haven't. One participant still owes 12 tons against February obligations this late in the cycle. That's not typical settlement behavior. So ask yourself, manipulation or coincidence? Let's assess both possibilities. Genuine technical malfunction versus strategic intervention. Because if you only seek confirmation of existing beliefs, you're no different than the mainstream narrative you criticize. Scenario 1. Legitimate technical failure. Exchanges suffer outages. CME operates complex systems. Natural gas resumed within 35 minutes. Metals required 90. Perhaps additional safeguards were needed. The post-reopen drop could be explained by stop-loss cascades and leveraged liquidations. Scenario 2. Calculated intervention. Zoom out and the timing raises eyebrows. His is the second major disruption in 3 weeks after half a decade of stability. The halt occurred 48 hours before March 1st notice day, with silver nearing breakout territory. When trading resumed, selling was immediate and forceful, driving price down $3 within minutes. All-day orders were wiped, effectively clearing the book in a way that advantaged institutions over retail participants. Jesse Livermore wrote in Reminiscences of a Stock Operator about how insiders controlling market infrastructure inherently hold the upper hand over outside speculators. When you control the exchange, you dictate when trading flows and when it stops. A precisely timed halt can achieve what overt manipulation cannot, resetting momentum when pressure builds beyond control. Consider the historical parallel. On November 28th, CME halted silver trading for 10 hours. Official reason: cooling system problems. Silver traded at 53.26 when trading stopped. That halt occurred on first notice day for December silver. Reports surfaced that a Chinese industrial entity had notified COMEX of intent to take delivery of 30 million ounces. When trading resumed, silver surged to 56.78, and then more than doubled to 121 within 2 months. Those cooling issues emerged exactly as delivery pressure intensified. The pattern is clear. Trading halts cluster around settlement windows when delivery obligations peak, and price challenges resistance that would intensify short covering. Wednesday's halt mirrors that structure. 48 hours before settlement, silver near 92. Registered inventory declining daily. Persistent Shanghai premium. Another key observation: COMEX open interest is falling while SLV records steady inflows. That's de-risking behavior. Capital is shifting from futures exposure to physically backed ETFs. When traders prefer ETF positions over futures contracts, it signals concern about delivery and counterparty performance. You don't abandon futures for ETF premiums unless trust erodes. The Shanghai Futures Exchange suspended 25 trading groups in February for exceeding position limits. We discussed this previously. That frequency of enforcement is unusual. Exchanges act when concentrated positions create systemic risk. When you see 25 suspensions in 1 month, alongside a durable $12 premium, while Western markets endure trading halts, these aren't isolated incidents. They form a mosaic. Supply relief isn't appearing anywhere. Mexico remains the world's largest silver producer, and security challenges are intensifying. Cartel violence complicates hiring and increases transport costs. The Trump administration's coordination with Mexico may eventually stabilize conditions, but for now, supply risk from the top producer is escalating, not easing. Revisit the November precedent. That cooling system halt preceded a 2.5x rally in silver over 60 days. Not because the halt was bullish, but because the delivery strain behind it was genuine. The halt was a symptom, not the catalyst. Physical tightness was the driver. When pressure couldn't be contained through ordinary mechanisms, extraordinary steps were taken. When trading resumed and delivery stress persisted, the rally accelerated. Now consider what could delay or suppress this setup. The March roll completed. 71 million ounces pushed forward, relieving short-term strain. Shorts can continue rolling into May and July. Shanghai premiums could contract. Mexico's situation might improve. Yet here's the counterpoint. The roll occurred, yet registered silver keeps declining. Physical metal continues exiting the system. Shanghai's premium remains firm despite Western paper price weakness. The structural ingredients that preceded Wednesday's halt, delivery pressure approaching settlement, elevated open interest, shrinking registered inventory, remain unresolved. Bottom line: silver traded at 91.30. Markets froze for roughly 100 minutes. Trading resumed with an instant $3 drop to 88. Now price sits near 89.20, defending prior resistance as support. Shanghai premium remains $12. COMEX registered inventory stands at 86.3 million, down 2.2 million Tuesday. March settlement is 48 hours away. February gold still shows 4,000 open contracts worth $2 billion that should already be resolved. Second CME disruption in 3 weeks after 5 years without major outages. COMEX open interest declining while SLV absorbs inflows. 25 SHFE account suspensions in February. November's precedent showed a halt on first notice day followed by a 2.5x rally when delivery stress proved authentic. Pull the vault data. Check the Shanghai premium. Verify the February gold anomaly yourself. Cognitive bias drives people to ignore facts that challenge preferred narratives. Most won't verify because verification forces uncomfortable realizations. It's easier to dismiss than to investigate. Those who examine the numbers don't need persuasion. This is financial warfare education, not investment advice. Position yourself with discipline, not emotion.